All right, if you're holding Rezolve AI, you probably had a bit of a shock this morning. The stock took a sudden, massive 20% dive, and it seemed to come out of absolutely nowhere. So today we're going to break down exactly what happened, why it happened, and what might be coming next. Yeah, waking up to a 20% drop before the market even opens, that's the kind of thing that makes your stomach sink. It's a really jarring number to see next to any stock you own. So let's get right to the bottom of it.
So, the big question on everyone's mind is just why? What on earth just happened? Was this a sign of some deep internal trouble, a market-wide panic, or something else entirely? Okay, let's dive in and get you the real story behind these numbers.
Turns out this wasn't some piece of bad news leaking out or a terrible earnings report. Nope. This entire event was triggered by one single, massive corporate move, a $250 million stock offering. What they did is called a registered direct offering. Now, that sounds complicated, but all it really means is they sold a huge chunk of brand new shares directly to some big-time institutional investors. It's basically one of the fastest ways a public company can raise a ton of cash. And this is where the rubber meets the road. Check out these numbers. Rezolve had about 300 million shares out there. Well, they just went and printed another 62.5 million new ones. You do the math on that, and bam, that instantly dilutes every existing shareholder's piece of the pie by roughly 20%. And that 20% number, that is no coincidence. So yeah, that dilution, that is the direct one-to-one cause of the price drop. Think of it like a pizza. Yesterday, the company was a pizza cut into 8 slices. Today, it's the exact same pizza, but now it's cut into 10 slices. The company itself didn't shrink, but your slice just got smaller. So the market just immediately repriced each slice down by, you guessed it, about 20% to match that new reality. Now, raising money can be a good thing for a company, right? But in this case, the timing was just awful. It was brutal for the stock's momentum. It was like throwing a giant bucket of ice water on a fire that was just starting to roar. I mean, this stock had some serious upward momentum building. The conditions were lining up, it was coiled like a spring, and a lot of folks were thinking a potential squeeze could have sent this thing flying towards $10 a share. This offering just stopped all of that dead in its tracks. And just look at what was lost here. The setup was absolutely incredible. You had short interest at a whopping 31%. There was a mountain of options activity centered right around that $5 strike price. If the stock had managed to break above $5, it could have triggered a massive buying spree of 4 million shares. But selling new shares at $4.80? That just dismantled the entire explosive setup. So what does this all mean for you, practically speaking? Well, because of that 20% dilution, you pretty much have to shave $1 off your old price targets. What was a $6 target yesterday is now effectively a $5 target today. It takes the same exact total company value to hit $5 now as it would to hit $6 just a day ago. It's a simple but pretty painful reset. So if the timing was so bad, why on earth would they do it? And that brings us to the why. Management knew this would hurt in the short run. They knowingly took this hit because they're making a massive bet on the long term. And this chart just lays out the whole trade-off perfectly, doesn't it? On one hand, you have all the short-term pain, the price drop, the crushed momentum, and a lot of frustrated investors. But on the other hand, they now have $250 million to go make a major acquisition. Their entire bet is that this new capital will fuel enough growth down the road to make everybody forget about this short-term mess. You know, we've actually seen this movie before. Let's think back to SoFi in 2020. They raised capital to go out and buy a company called Galileo. And let me tell you, a lot of investors hated the move at the time. But that acquisition turned out to be an absolute home run for them, creating immense long-term value. It really seems like Rezolve is trying to run that exact same play here. And this right here is the reason for all the drama. $250 million. That is a serious war chest. With that kind of firepower, Rezolve can now go out and acquire another company, one that they hope will add significant, game-changing value to the business. So, how did the market react? And more importantly, how did the retail investors who follow this stock so closely take this jarring piece of news? And this is where it gets really interesting. You'd think everyone would be furious, right? A 20% haircut overnight? But look at this. Sentiment among retail investors is still overwhelmingly bullish. It seems a lot of people are looking right past the short-term pain and focusing on that long-term story. And it's not just a feeling. The chatter about the stock online has absolutely exploded. We're talking a massive spike in discussion. And this isn't just angry venting. It suggests a huge number of investors are seeing this dip not as a crisis, but as a big-time buying opportunity. So this brings us to the final, crucial question. What happens from here? What are the key things that you should be watching for now? All eyes are now on two key events. First, the offering has to officially close. That's mainly paperwork. But the big one, the real main event, is step 2, the announcement of what they're buying with all this money. That's the news that could redefine the company's future, and it could drop at any moment. And that really is the ultimate question, isn't it? The entire move, the entire story, now hinges on the quality of that upcoming acquisition. Its success or failure will be the difference between this being a costly misstep that destroyed a ton of shareholder value and a calculated masterstroke that sets the stage for years and years of growth. For now, we wait and see.